I'm going to predict that we've already seen the Fed pivot. Now, it wasn't a pivot in the sense that the Fed has gone from hiking interest rates to cutting interest rates. It hasn't gone from quantitative easing to quantitative tightening, but it is a pivot in rhetoric. And what it amounts to is an easing of monetary conditions, because what the Fed is going to be doing, I think, going forward is starting to walk back just how aggressive its rate hiking campaign is going to be. Instead of talking about how critical it is to fight inflation, I think the Fed is going to be talking about the progress that they've already made in their inflation fight. And therefore, since they've made progress, maybe not completely declaring victory, but indicating that they're seeing the light at the end of the tunnel, that maybe they don't have to raise interest rates as high as they thought, or maybe leave them as high for as long as they thought. And so the path back down to 2% inflation may not require as aggressive a rate hiking campaign as they may have previously thought before they started to see the evidence of their success. And the reason I think this is happening, and the reason I think it has happened, is because Thursday of last week, the bond market really looked like it was about to collapse, and how quickly interest rates were rising. In fact, at the beginning of last week, the yield on the 30-year Treasury finally got above 4%. And in fact, on Thursday morning, it almost got to 4.4%. That was a huge move intra-week. Remember, I said that I thought the move from 4% to 5% would be even quicker than the move from 3% to 4%, and that was on pace to come true. And one of the things that was very problematic in the bond market carnage that was going on last week was that the yield curve had moved to positive between the 10-year and the 30-year, and that's how it should be. And I had been predicting that that would happen because I thought that the markets would start to price in the extra inflation risk that would exist by going 20 years longer on the bond curve. You see, more people were focused on a recession and the Fed cutting rates, and they weren't paying attention to what that meant for the long-term inflation rate. Well, I think bond investors were starting to figure this out, and that's why they were selling off the 30-year bond even more aggressively than they were selling off the 10-year bond, because the Achilles heel of this bubble economy is interest rates, because we've got so much debt. And if interest rates rise high enough, the whole thing is going to collapse. I kept tweeting about that. As a matter of fact, I think it was on Thursday, just pointing out just how dependent the United States is on artificially low interest rates. In fact, on Friday morning, I tweeted out the following. The 10-year U.S. Treasury yield hit 4.33%, its highest since November of 2007, when the national debt was still under $9 trillion. Today, it's over $31.2 trillion. At 4.33%, annual interest payments on the national debt would exceed $1.35 trillion. That's more than the U.S. government spent on national defense or Social Security. Think about it. At that rate of interest on the national debt would be the most expensive government program, because right now, the most expensive is Social Security. I think it's about 1.2, 1.3 trillion a year. National defense is about $1 trillion a year, but interest on the national debt would be 1.35 trillion. Now, it wouldn't get there immediately because a lot of the debt is still locked in at lower interest rates, but it's not locked in for an extended period of time. So as all that short-term debt matures and has to be refinanced at current market rates, the overall cost of the national debt continues to surge, and ultimately we would have that $1.35 trillion price tag in a few years. But of course, in a few years, the debt itself will be much larger than it is today. So it's not even going to take that long for net interest payments to be that much money when you keep compounding the size of the debt. And of course, as rising interest rates weaken the economy, that alone increases the debt. The weaker the economy is, the bigger the deficits are, the faster the national debt is rising, and now all of that debt has to be financed at the higher interest rates. Then I said when the national debt hits 35 trillion next year, which I think it will, at a 6% rate of interest, annual interest payments on the national debt would exceed the national defense budget, welfare, and education spending combined. Can you imagine spending more on interest on the national debt than defense, welfare, and education combined? Now, if interest rates went to 8%, which they would have to do just to equal the current rate of inflation, then interest on the national debt would exceed what we spend annually on Social Security, national defense, and education combined. You see the problem here? Debt is spiraling out of control, and it's going to crowd out all the other government spending. In fact, the last tweet I made on this subject was the following: at the rate the national debt and interest rates are rising, before the decade ends, interest on the national debt will exceed 100% of federal tax revenue. That would mean the entire federal government would then consist of just the Treasury Department, which would collect taxes and pay interest on the debt. Basically, the U.S. government would be a conduit from taxpayers to bondholders. Now, obviously, this can't happen. At some point, something has to give. And I think that something already gave. I think it gave on Friday morning, and that's why I think the Fed folded with this soft pivot. And again, the reason I'm saying it's a soft pivot and not a hard pivot is because the Fed is still on the trajectory of hiking rates. I just think it shifted into a lower gear. And so that in and of itself constitutes an easing. Even if the Fed is still tightening, if it's tightening less aggressively than the markets had thought, then it's an easing. It's a forward guidance that is easing conditions a little bit and telling the markets, hey, you're too tight. You're pricing in too many rate hikes because we're probably not going to have to hike as many times as you think. The terminal rate is not going to be as high as you think because we're already making good progress. Now, that is all BS. They're not making good progress, but they have to say that because there's no real alternative. Now, the way this pivot was telegraphed to the markets was through a Wall Street Journal reporter who basically said he had it on good sources that the Fed is going to be indicating that future rate hikes will be somewhat smaller than what they had previously indicated. So maybe we'll have one more 75 basis point rate hike, but then going forward, there'll be 50 or 25, or who knows, maybe the next rate hike won't even be 75 basis points. It might be 50 basis points, especially if we keep getting economic data like the economic data that we've already got this week. So this is very difficult for the Fed because they are hiking interest rates into a weakening economy.